Hi, and welcome to Visual Sectors. Everyone talks about the Federal Reserve, Jerome Powell, and the policy. In this video, we will give you a comprehensive overview of the effects of the Fed policy and break it down for you in simple terms. Stick around for the bonus section, and we'll show you how to profit from this information. Let's dive in. Visual Sectors is a London-based investment data provider. Our data sets predicted the December 2021 high and the June 2022 low. Every day we process millions of data strings to provide you with simple and clear insights. Please subscribe, like, and share this video if you find it helpful. The Federal Reserve's balance sheet and the S&P 500 are closely related, as you can see on this chart. The Federal Reserve's balance sheet has experienced a significant increase post-COVID. The market exploded. Now, the S&P 500 witnessed an incredible 120% growth, while the Fed balance sheet showed almost identical 115% growth. The similarities don't end there. Since 2008, the Fed tried to reduce the balance sheet several times, which always led to market turmoil, with 2018 being the most significant, with a 16% balance sheet decrease, which led to a 25% market decline. Same for 2022. The Fed had only $500 billion off their sheets, which is only around 5.5%, but the market lost 25% of its value. So the main conclusion is going up takes more fuel than going down. It seems obvious, but people keep buying stocks with the Fed committed to reducing the balance sheet by another trillion in 2023. The cost of interest rates to the economy can be significant, especially when they're growing. As interest rates rise, the cost of borrowing also increases, which can have negative consequences for both corporations and households. Banks raise the rates at double the speed of the Fed. Actual interest income of banks show the rates went up to 16% from 8%, while the Fed only increased their rate from 0.25% to 4.75%. For corporations, an increase in interest rates can slump their profits. Higher interest rates make it more expensive for companies to borrow money, which can lead to a decrease in investment in new projects and expansion. This can slow economic growth and lead to job losses. For households, an increase in interest rates can lead to a decrease in spending. Higher interest rates make it more expensive for consumers to borrow money, which can lead to a decrease in spending on big-ticket items such as cars and homes. This can also lead to a decrease in economic growth and job losses. Now, after the rate increase, the cost of debt service for the economy has risen from 15% to 30% of GDP. The expense is outrageous. People will not be able to pay their debt. Companies' valuations will skyrocket, and some may even file for bankruptcy. The Fed only really affects inflation in part. Less money out there affects consumers and business activity, but the energy prices are supply-driven, so the Federal Reserve has no actual influence over those. Although very indirectly through recession, it can affect demand and, in the long run, bring the energy prices down as well. A high Fed rate affects goods, new cars, used cars, apparel, and medical care commodities. The higher the rate, the lower the prices because it negatively affects demand. Now, the opposite is true for the housing market because the housing market is dependent on mortgages. Accordingly, when the Fed raises its rate, the banks in their turn raise their rate, making it more expensive for landlords to service their homes. Landlords, therefore, raise the cost of renting because their cost of owning the property goes up. In order for the Fed to arrive at its percentage inflation target, it must drive commodities, less food and energy commodities, into a severe recession or publicly admit that they do not include medical care services or shelter in their definition of inflation. That is, 2% inflation should refer to commodities, food, and transportation services. All other inflation should supposedly not count. Only then can the Fed achieve its goal. The only other way is to admit that 2% is unattainable, and they will target 3 to 3.5% CPI for the foreseeable future. The Fed rate is always an intriguing event. At the end of 2023, two members are expected to vote 4.75 Also, 10 are expected to vote 5 to 5.25. 5 people are supposed to vote for 5.5 and 2 more for 5.5 to 5.75. This is the consensus of the Fed that the rate should be above 5%, around 5.25%. In other words, this is the Fed members' forecast based on the dot plot. Now, there is also a market reaction. The market's expectations for the rate are based on futures. The market chronically distrusts the Fed. Bloomberg's lead investors think the rate should be around 4.9%. It won't go higher than 5%. The upshot is that the Fed expects the rate to be higher than the market expects. So the optimism is unjustified. So be careful reading the mainstream media. What could affect the Fed's decision? Well, in 2018, the Fed was influenced by the market's downward movement. They got scared and changed their policy under the pressure of the market. In December 2018, the market fell 25%, and the Fed reversed their policy after that. Now it's no longer working. Attempts to adjust the rate by Wall Street selling activity and top-tier bankers' comments failed in 2022. White House officials, especially Janet Yellen, tried to verbally push Powell several times, but also failed. The only power able to promote policy change is Congress. If the labor market gets on Congress's agenda, the next testimony by Powell will be a hard one. It's likely that the Fed will eventually be forced to give up after that. Now, the market is looking up to the Fed speakers. They look at the labor market and inflation. No easy way out until both indicators have high values. So here's a little summary. Number one, the balance sheet is almost a 100% correlation to asset prices when the balance inflates, but going down is way faster. Number two, banks raise the rate at double the speed of the Fed. So a tiny 0.25% increase by the Fed turns into a massive $200 billion in extra cost for the economy. Number three, high rates keep the services, especially shelter, getting more expensive. Nothing the Fed can do here. Number four, unrealistic market expectations will end up in a downturn. Nobody in the FOMC is expecting to lower rates in 2023, but the market does. Finally, number five, it's Congress that has the power, not the White House or Wall Street, and they only care about employment these days. This research was provided by visualsectors.com, and there is plenty more to come. Make sure you subscribe, hit the notification button, and share this video with all your friends. Visual Sectors is developing exclusive new data sets, providing unprecedented win rate. Please check out our Money Flows data set showing the direction of markets, sectors, and all optional stocks.